This probability matrix analyzes decades of market data from the US, UK, and Australia. It reveals that taking a large sum of cash and investing it all at once outperforms a slow, staggered entry 68% of the time. This is lump sum investing. Mathematically, it works because markets trend upward over long periods. Money that sits on the sidelines waiting for a better time earns nothing, while a single early injection captures the full move of the market. But this creates a statistical paradox. If the math favors dropping all your cash in at once, why do massive US brokerages like Fidelity and E-Trade spend millions urging investors to set up smaller, recurring automatic payments? Theoretical Wall Street math assumes investors have perfect discipline and endless capital. In reality, human psychology and the constraints of a monthly bank balance make the mathematically superior choice impossible for most people to execute. The Vanguard study assumes you already have $1 million ready to deploy. Most of the U.S. workforce builds wealth in increments, using a biweekly paycheck to fund their future. This wave chart shows the cycle of greed and fear. Historically, retail money flows into the market at the absolute peak, when optimism is high. When the market inevitably dips, that same money flows back out as investors panic and sell at the trough. Investors who hold cash while waiting to buy the dip often wait too long and miss the recovery. Missing just the market's 10 strongest days can reduce a portfolio's total value by half over several decades. Market timing fails because the investor's own instincts create a greater drag on returns than the fluctuations of the market. Investors often act as their own biggest financial obstacle. Dollar-cost averaging serves as a mechanical override for the human instinct to panic. With a fixed monthly contribution of $500, a $20 share price buys 25 shares. If the price drops to $10, that same transfer automatically buys 50 shares, forcing you to buy heavily when assets are on sale, without a single conscious decision. Millions of Americans already use this strategy. Workplace 401k plans use automatic payroll deductions to effortlessly move money from a paycheck into the market before the investor has a chance to spend it or change their mind. This automation also captures the employer match, a guaranteed return on capital that provides a significant buffer against market volatility. Automation removes the friction of daily decision-making, turning wealth building into a background process. Automation can't fix the drain of excessive fees. That is why the U.S. Securities and Exchange Commission requires funds to disclose their operating expenses. Shareholder fees, like 12b-1 marketing charges and front-end loads, act as a tax on your growth. This money is siphoned away to pay for fund advertising and broker commissions, rather than being invested in your portfolio. Over 20 years, a 1% difference in fees leads to a 23% difference in your final balance. On a $10,000 investment, a low-fee fund grows to over $24,000, while a high-fee fund leaves you with $4,000 less. Low-cost U.S. index funds, which track broad markets like the S&P 500, allow you to bypass the high costs of active management. A strategy of automatic purchases and low-cost index funds essentially automates wealth creation, removing the need for market timing luck. The Vanguard paradox is easy to resolve. If you receive a windfall today, the math says to put it all in. But wealth isn't built on one-time events. It's built on momentum. Success for the average person comes from staying in the market, even when a spreadsheet might suggest a more optimal entry point. Log into your brokerage, set up a recurring transfer into a broad index fund, and ignore the daily news cycle. Financial success is the result of taking your hands off the wheel and letting compound interest do the work for you. Investing should be a habit, not an emotional struggle. If you found this breakdown helpful and want to build better financial habits, make sure to like, share, follow, and comment on my channel USFINOX. We'll see you in the next one.